Alrighty, what's going on? Welcome back to the DuLowe Deals Real Estate Podcast. I'm your host, Shawn DuLowe. Today we're joined by a very special guest. You may know him as the Metal Mortgage Man or Zeke Zurinskas. Zeke Zurinskas, correct?
Zurinskas.
There you go. I like it. I like it. Um,
It's not really Italian, but Zurinskas.
it's got that.
Rolls off the tongue.
It's got that Italian tang to it, man. I feel it.
When I say it like that, it does, right?
Yeah. How's it going, man?
All right. Well, my name is Zeke. Yeah, I go by the Metal Mortgage Man. As you can see from my posters in the background, that's my music of choice. I guess that would be my MIC. But I've been in the mortgage business for 28 years. I got into it in 1996, and I'm the branch manager at Meridian Bank. And yes, this is my office at the bank, drumsticks and all. But yeah, 28 years slinging mortgages. First 12 years was in subprime. And then after that was delegated correspondent banking. And now working for an actual bank for the last 8.5 years. So this is what I do. It's all residential lending, although we do have a commercial division, but I'm not in the commercial division per se. And yeah, I love what I do and I like helping people. And this is just where life took me 28 long years ago. So nice to meet you all.
Yeah, that's awesome, man. Very, very good introduction. Now I actually met Zeke. I actually met you at a presentation that you guys were hosting. I got your presentation binder in front of me.
That's right.
Yeah, I was studying up on it before our podcast here, and you guys offer a lot of great programs that I don't really see any other banks offering or any other mortgage companies offering. Like one of the ones that really stands out to me is the zero down 100% FHA CLTV financing. Would you like to touch on that a little bit?
Well, that was the first flyer in that brochure. And what that is, it's a program that's somewhat newer to us. But basically, when a bank is doing business, we operate in a realm of what's known as yield spread premium. So par is generally a 0-point loan. A customer always has the ability to buy down the interest rate by paying what's known as discount points. Well, with that program, that's a program that we have that's offered to repeat homeowners, whereas we will actually take the yield spread premium that we make on the loan and we'll put it back into the down payment for the consumer. So when somebody is utilizing that program, they're not necessarily getting the best interest rate. In lieu of getting the best interest rate, we're giving them cash so that they can use that cash to meet the down payment requirement of the loan. So that's kind of how that works. And that's what's known as yield spread premium. So we always operate within it. That program allows us to take our yield spread premium and give it back for down payment. And that program's available to not first-time home buyers. So you can be a repeat person. You could literally have an FHA mortgage and you're selling that home, but you're making no profit and we're giving you money anyways out of the yield spread premium on the loan. So yeah, that's kind of how that works. That's pretty cool. A lot of the things that I had showed you initially were pertaining to low down payment options, and we've got a lot. New Jersey actually has a lot of options for low or even no down payment. So that's
Yeah.
one of them.
Yeah, I remember another one that you guys offered where you guys actually offered grants that you could stack on top of the New Jersey
Yeah.
homeowners grant.
Right. So everybody's aware. Well, most people are aware of the New Jersey homebuyer program. So there's 3 programs that a person can get. You can get the first time homebuyer program, which is literally called the first time homebuyer program, or you can get the homeward bound program, or you can get the HFA Advantage program. And each program's a little different when it comes to the processing and the interest rate, but they all give you down payment assistance starting at $10,000. From there, it goes from $10,000 to $15,000 to $17,000 to $22,000. And that's the most that you can get through New Jersey Housing's program. But the grant that you're mentioning is the First Front Door. And there's also a First Front Door's Keys grant, which are for $15,000 and $20,000, and they can combine. So theoretically, somebody can get our key grant, which is $20,000. Yeah, it's $20,000, or they can combine that, and they can combine that with New Jersey's housing. So in theory, they can get as much as $42,000 for down payment assistance, combining the two.
That is beautiful, man. I
It's
have
pretty
not,
good.
yeah, I have
Yeah,
not seen that
yeah.
anywhere else.
They combine. I know it's nice having stacking grants, and the First Front Door grant will even stack with other grants like ACIA's grant, or I don't know if Gloucester still does it, but they used to have a GCIA grant. I haven't done one in years, but you can stack them together, which is pretty cool. Yeah,
Yeah.
so Meridian's one of the few banks in South Jersey that actually offers that, and it's only because we're a federally chartered bank that's based out of Pennsylvania. So that program's only available to federally chartered banks out of Pennsylvania, Virginia, I think it's West Virginia, and Maryland, I think, 3 states, and we're one of them. So it's kinda cool. It's, like, a little unique, and being in South Jersey, I don't know of anybody else around here that offers it.
Yeah. Yeah, no, I have like I said, I've never worked with anyone that's offered that. It's a great program. The main objective of this podcast was actually to kinda talk about what it takes to become a homeowner in New Jersey for, like, first-time home
Yeah,
and stuff like that.
right.
Yeah, so from your side of things, what do you normally look for? How does that work on your end?
Well, the process is always the same. There's 3 things that a customer needs to have in order to buy a house for a primary residence anyway. And I guess it applies for investment properties or second homes, but it all boils down to 3 things. They have to have the credit, got to make enough income to debt service the mortgage, and there are different debt ratio parameters based upon the type of programs the credit will qualify them for, and then have to have enough money to meet the down payment and closing cost requirements. So whenever I'm interviewing somebody, those are the 3 things that we look at. So a conversation typically will start, "Hey, how's your credit? Are you everything okay? You paying all your bills on time? Do you have credit cards, any installment loans, student loans?" So we have to look at that. So the credit report will create a standard, which is known as a Fair Isaac score. The Fair Isaac score is what opens up the doors to different programs. So if the Fair Isaac score is on the lower end of the spectrum, typically the only type of mortgages that are going to be available are your government loans, whether it's a VA mortgage or an FHA mortgage. Could be USDA as financing, which is one of your 4 types of government loans. If the credit score is on the higher end of the spectrum in the 7 or 800s, that opens up doors for conventional financing.
Okay.
So, yeah, so the credit report, it tells us which direction we're going to travel. The income tells us how much mortgage they're going to be able to borrow against. And then, naturally, if it's an FHA loan, we have to have the minimum down payment and money for closing costs. Same with whether it's USDA or conventional. But yeah, so that's kind of the 3 things that we have to review for every single file, at least when it comes to primary residences. With investment properties, it gets a little bit more exotic because there's profit and loss loans and DSCR mortgages and these new things that are starting to come around. Getting back to the qualifying criteria, so, we know about the credit and the standards related to the credit. Lower scores go for government loans, higher scores go conventionally. Debt ratio is another big thing to talk about. If you're getting a government loan like a FHA mortgage, for instance, the house that one is buying cannot exceed 46% of the gross income that we're using for the customer. And then when we sprinkle in their personal debt from the credit report, that cannot exceed 56%. And those are the standards as an FHA mortgage. So
So
when it comes, yeah, when it comes to what one can qualify for, if we know what the income is that we're going to give them credit for a month, times that times the percentage that we have to go off of. So if a customer's income is literally like 10% of what or I'm sorry, if a customer's debt is 10% of their income or greater, we would go off of the housing ratio. So we take the income times it times, let's say 45%, and
yeah.
then we minus taxes, insurance, and an estimate for mortgage insurance. That tells us the allotment for principal and interest, and then we divide that by rates of the day. So if it's 6%, it happens to be $6 per thousand. And that's how we come to what one can qualify for. So the math of it is just knowing the equations. So it's relatively easy.
Okay.
And then getting into the last column, which is the down payment, there's a minimum of 3.5% down as an FHA mortgage. And then you need money for closing costs. And closing costs will vary from state to state. New York will be real expensive. Pennsylvania will be second in the tri-state area, let's say. And then New Jersey is actually relatively cheap compared to other states around us.
Okay.
And
Interesting.
that's just for FHA. And then you times different criteria. USDA is going to have different guidelines and conventional loans have different ratios. So yeah, it's interesting, but it all starts with the credit because the credit determines the flow that we're going to go.
Yeah.
So yeah, that's kind of how it all works. It's not rocket science. You just have to know the flow.
Okay. Now, being on the other side of the business, when working with new buyers, you do run into a lot of different experiences. However, some of the same experiences come up repetitively. If you could say 3 things that you wish all home buyers knew or first time home buyers knew before applying for a mortgage or before trying to close on a deal, what would you say those 3 things should be?
Should know.
Yes, yeah.
I guess, when it comes to three things that they need to know, if you think that you're going to be buying a house, don't make other crazy purchases. And this is kind of reflective. I think of this because yesterday I got a phone call from somebody who wants to buy a house up in upstate New York. And I pulled up her credit report, and 2 months ago, she bought a car. And the car loan was like just over $50,000, and it's greater than $1,000 a month. Now, so, again, if the rate per thousand and a 6% interest rate is 6% on the money, $100,000 loan is $600 a month. So this woman has like $150,000 mortgage, $160,000 mortgage with this car payment.
Yeah.
And if we go off of ratios in and around 50% debt ratio, that car payment at $1,000 plus a month is going to take $2,000 of her income just to cover that debt, let alone the house, taxes, and insurance. So she's lost $24,000 a year in income because she bought a car 2 months ago.
Yeah.
So one thing to know would be don't make any crazy purchases before it becomes time for you to buy a house. So if you're 25 years old and you know that come the new year you're going to want to buy something, don't buy the car. Go on Craigslist and buy $1,000 beater if you really need something to drive around with. You don't need a $30,000 car loan that's going to pull away from your debt ratio and maybe make it impossible for you to buy.
Yeah.
I don't know. Other things to know might be save your money. And I think of this, there's a customer that another customer that I have now that everything is perfect, except he didn't realize that he would have to have money in the bank. He's got cash literally in the closet. And when you have cash money, it's almost like having an under the table job. I can't give you credit for the cash. You have $20,000 in your closet, but it does me no good because I can't utilize it. After 9/11 happened and a lot of changes were made in the banking world, but basically the Patriot Act was passed. And as part of the Patriot Act, we source money going back at least 60 days. So if one has unusual non-payroll related deposits, we question it. And then we might even throw it out. What's this $7,000 deposit? I can't track where it came from. You're not going to get credit for it. So if you think that buying a house is going to be in your future, put the money in the bank now. That way, when the time comes, you have it and we don't have any problems related to assets.
Yeah. Yeah.
Yeah, you had one.
Yeah, that last story kind of reminded me of one. So the last client that I actually ended up working with, we had a similar situation, except he ended up lying on his mortgage application as well. Yes. Now, when he did that, he was going to get the grant or whatever. Didn't end up getting it because of the whole, lying on the application ordeal. And then at the end of closing, since stuff got switched up, he needed to get a certain amount of money so that way we can afford to still make it to closing. He did not disclose how he got the money. He just told us he got the money, even though we told him how to get it. And
Right,
yeah,
right.
and it really just screwed everything up. The deal almost died.
Yeah.
So the two things I would say to that is one, always listen to your lender and your agent. And then two, make sure that you don't lie on your mortgage application. That will come back to bite you down the road.
Yeah, yeah. Well, no, you don't want to lie, and when it comes to a loan officer to a certain degree is a buffer. You have to be honest, and be forthright. When it comes to assets, a lot of people think, oh, well, yeah, I got $100 bills. They're in a shoebox or over here. It's my money. It's my shoebox, who's going to question that? But it really does. We look at the underwriting process of it all. We have to look at what we can verify. And that's looking at the bank statements, payroll deposits, fine. Gifts, fine. We just have to source where the money came from for the gift and that it's an acceptable donor. But cash, you just can't do nothing with. So if they're not honest about it, or sometimes it's not even a matter of honesty, I guess it's a matter of they just don't know, it's a new process. And a lot of people operate in cash. They just let a little bit of money in the bank and they keep all the rest and they put it where they put it. And that's it. Could be in the ground, get the, get the metal detector out when it comes time to get gas for the car. Where'd I put the shoe can?
Yeah.
But yeah, those are big things. Assets tends to be the one thing that does get overlooked. There's a lot of focus in the mortgage process. The credit report's very important. The credit report determines the flow of the mortgage and how it's going to go. And then the income Income is a big thing. You don't want to screw it up. What type of employment is it? Is it self-employed? Is it 1099? Is there tips? Is it W-2? Do they take lunches out? What's the stability of it? Is your hours variable? Variable pay is looked at a lot differently than other pay. So a lot of times the focus really falls within credit and income. And then we tend to just find out. We literally stumble into asset problems because when I'm asking a customer for mortgage related documents, it's always the same. Give me your last 2 months bank statements, all numbered pages, even if there's nothing on them. And then it's like, well, what's going on with your bank account? Who are these extra people? What's all this cash? So, we kind of stumble into the assets, and it's the third big category, but it's not always the easiest. And I'm battling with it on a couple deals. I'll be honest right now. You get the bank statements in, and it's like, what's going on here? Tell me what this is.
Yeah.
So, I'm always cautious when it comes to assets these days because you can put a lot of time and focus on it, and we might not be able to give credit for things. So, yeah, but you're right. It happens. Stuff just pops up, you know?
Yeah. Yeah.
I guess that's life.
Yeah, yeah. I mean, another thing that I've been hearing a lot, I've been hearing that they're anticipating a rate drop pretty soon.
Yeah.
What's your thoughts on that?
Well, everybody's excited about it, but it's not like, let's say if interest rates are 6%, in a month when the rate cut's going to be happening, it's not like all of a sudden it's going to go to 5.75%. It doesn't work like that. The Fed's interest rate is a rate of exchange between banks. And what'll happen is when Powell made that speech, I guess it was a Monday or last week. Well, I think it was on Friday when he gave that speech and he indicated that it was going to be cutting rates. The market rallied. The Dow was up. Money was going into mortgage-backed security, and we saw interest rates improve, which actually brought down the national average with where we are with interest rates right now, which is I think it's a 6.54%, which is the lowest it's been in a long time. So this rate cut's going to be a great thing, but it's not going to happen the day of. The rate cut is actually starting to happen in the weeks to come. So the market, if it's anything like the last big rate cut that we had in 2024, the market actually built it all in. So before the rate cut actually happened, the 2 or 3 weeks before that, interest rates dropped and dropped and dropped and dropped and dropped. And it brought us down to a national average at that time at like 6.25%. The day after the rate cut happened, we had that 50 basis point rate cut. Literally the day after it happened, interest rates started going back up. So the market built in the cut beforehand a year ago. And it was wonderful. We locked in all of our deals before the rate cut. And then all of a sudden, boom, it happened. And then rates started going up. So it's kind of weird how it happens. The market is going to time this thing into it. And hopefully in the next week or 2 or 3, we're going to see interest rates come down even more. So we had a good day on Friday. Today and yesterday were kind of neutral days, but the averages look good. It's 6.54%, which means some people are getting a little bit less, and some people are a little bit more. But so keep them coming, I mean, hopefully we get the right people in there and we just keep going down and down and down.
It's the goal, man.
That's everybody's prayer, I mean, who wants to pay interest?
So when the interest goes down, for the people that don't know, what exactly does that mean? Does that mean that they can afford more? Does that mean that their pre-approval amount goes up? How does that work?
Yes.
Yeah.
That's right.
Okay. Yes.
Well, when we talk about 6% as an interest rate, the rate per thousand on a 30-year mortgage is $6 to pay back every thousand. So a $100,000 mortgage is going to cost $600 a month. And I use 100,000 because it's an easy number. Well, if you were 1% higher at 7%, which happens to be the devil's interest rate, the devil, right?
Yeah. Yeah.
I call it the devil's interest rate because it's $6.66 to pay back every $1,000 that you're financing on a 30-year mortgage. So here you have the spread from 6 at 6 to 7 at 6.66. The rate of change of exchange per 1/8% is roughly the 8 to 9 cents. So the lower that you go, it'll go from 8 to 9 cents to 8 to 7 cents as you go further back. 4 3/8%, for example, is $5 to pay back every thousand. So the lower the payback per every thousand, the easier it is for a customer to qualify. So $100,000 of 7% is $666 a month. So it's going to take more income to debt service a 7% interest rate than it would a 6% interest rate. When we had interest rates of around 2.75, 3%, you could make $50,000 a year and might qualify for a $250,000 mortgage. It was possible. And back then, 5 years ago, you actually could buy a nice house for 250, 260. Now we have properties are just appreciated through the roof, and you would know all about that. The $50,000 these days only gets a $160,000 mortgage. It's just because of the rise in interest rate.
Yeah, yeah. So I mean, like you were saying, just a few years ago, $250,000 could have got you a nice house. I mean, South Jersey, you're at about $450,000 as a property average sales price, but South Vineland alone,
Yeah.
and you're at 350 something thousand dollars. So it's just, and that's New Jersey's pretty much cheapest area, you know? Yeah.
Oh, what is the net? I forget the numbers, and I haven't thought of this in a long time. But when you look at the national average, home sale price, it's in the 400,000s. Where exactly it is, I forget. I think it was right around 430, 440,
Something like
something
that.
like
Yeah, yeah,
something like that.
yeah.
It's nuts. Where was it 6 years ago? It was probably $100,000 less. Easy, maybe more. I don't know. So you haven't seen people's wages increase to match the rate of inflation on housing. So it's tough. It's not easy.
Yeah.
What I find is a lot of people team up. You might have two people, boyfriend, girlfriend, they have to combine their powers, like the Wonder Twins, superpowers. And that's what makes it work. You take two people making $20 an hour, 40 hours a week, that's the only way a lot of people are able to do it,
Yeah.
and that gets them into some sort of a sales price range these days. So
Without
what do you think?
I think without that extra income, it's almost impossible to do. With with where I'm at right now, man, I mean, me and my girlfriend, we had an apartment about a year ago. We were saving up for a house, and we had the money saved up, but we just thought, we were like, we're young enough. If we move into a house now, yeah, we'll have that equity, but at the same point, it's like we should we should wait a little bit and save that extra money up. You know what I mean? Build that safety cushion. You know?
I do think the rates are going to improve greatly a year from now versus today, because I think that, once the new year hits and Powell is out and all these people are out and the new staff at the Fed is going to be in, we're going to see things improve rate wise. So I tend to lean against telling people to wait to buy, because there's always the power to refinance in the future.
Yeah.
The only thing that would hold back the power to refinance for an individual would be if depreciation sets in. And that's actually what happened in 2006. In 2006, well, I guess if you go back to the early 2000s, property values just kept going up and up and up and up and up and up and up. And then subprime collapsed. The whole world fell apart. Nobody was able to refinance. The buy and bail was created, where people were saying, oh, yeah, I'm going to rent my house and I'm going to buy this house over here down the street. But then they didn't rent the house. They lied on their application about it. They let it go to foreclosure and they purchased another one. The buy and bail was because they couldn't afford carrying two houses. So they used the rental income on the one that now was underwater because of depreciation. And then they saved their money. They purchased another one, but they lied about this one. This one was a lie.
Yeah. Yeah.
So the only thing that would keep anybody back from being able to refinance a year from now or a year and a half from now would be depreciation. But I don't think that's going to happen, because I think we hit new floors. With so many houses that have been sold, at these higher prices over the last three years or so, I think that you create new floors. You might have a little depreciation set in, but with the protections that we have, I don't know. I don't think it's going to be another 2006 situation.
Yeah.
And even after 2006, HARP was created, which HARP was this amazing tool that let people refinance, even though their house was underwater. So you could have had $100,000 house and you owed 150 against it, and HARP would let you refinance the loan. So that was a big thing in like the early, I guess that was like the tens, 10, 11, 12, 13. HARP was a big part of the mortgage business. I don't know. I got no idea, because we haven't had any negative upside down mortgages in a long time. So now I got some questions for you. I actually hung them up on my board
Yeah.
here.
Go ahead. Shoot.
So, how are Atlantic and Cumberland County different from the rest of New Jersey when it comes to buying a house?
So it's funny that you're asking this because, like I was telling you on the phone, I actually just did a market update last week. So these statistics are actually pretty fresh. So right now, Atlantic County, we actually have higher inventory. We're sitting around 10 months of supply, which basically means that you have more buyer leverage. Everywhere else in New Jersey, it's pretty much a seller's market right now. However, with that 10 months of supply, you have a little bit more wiggle room. You know what I mean? And then the median sales price is sitting right around 370,000 to around $400,000. As far as Cumberland County goes, it's a little bit more affordable. It's a $280,000 medium. It's up 10% year over year compared to last year. So sales prices are still rising, but it's still a little bit of a seller's market. So pretty much between Atlantic County, Atlantic and Cumberland County compared to the rest of the state, you're showing a little bit more breathing room than North Jersey, but prices are still rising.
Yeah.
Yeah.
Yeah, you know what I think it is? I think New York is like the sun of our, housing universe because you have so many people that, are escaping from New York and they're going to Parsippany or they're going to Hoboken or they're going to Brick or they're going to, close to New York, within half an hour, 40 minutes driving time. And you have so much demand from not only people in New Jersey, but these New Yorkers, maybe even people from Connecticut. They may be coming over here, and I think that's why it stays a seller's market up there, more so than down here. We're not so much you don't see people buying houses in Ocean City to drive 2 hours to New York every single day.
Yeah.
But I think you have a lot of people that are escaping New York, and that keeps North Jersey as a seller's market because you got all these people that still need housing, and it keeps that rate of appreciation nice and high.
Almost half of my clients right now are actually from up north coming down
Yeah,
here because it's just so expensive up there. You know what I
yeah,
mean?
right.
So I think,
Well, we got some nice roads to drive down, you can take the New Jersey Turnpike, you can take the Garden State Parkway, get the hell away from New York.
yeah,
I'll tell you the one thing that I always deal with when it comes to North versus South Jersey.
yeah,
I'm in Atlantic County. So Atlantic County like stops at the Mullica River. Once you go across the Mullica River, it almost turns into North Jersey. Little Egg Harbor, once you get to Tom's River, once you Brick, all up that way. But every single deal has attorneys bracketing both sides of the deal.
really,
Every deal. There's not like none that don't have attorneys.
yeah.
It's all attorney driven. And the further north you go, the more the attorney fees are.
Yeah, I mean, it makes sense too, because the one client I was just telling you about that, well, the one that I just got under contract that's coming down from North Jersey,
Yeah.
typically out here, I don't really use attorneys with my clients unless the seller's getting an attorney, because it just doesn't make sense. You're just wasting that money, in my opinion.
He's got one though, doesn't he? He's got an attorney.
Yeah, of course, he got the
What
attorney
tours he
in.
got?
Yes, exactly, yeah. It threw me for a loop, threw the seller for a little bit of a loop, but everything's all good now, you know?
Yeah. It doesn't happen down here. If you're in Cape May County, Cumberland County, Atlantic County, Gloucester County, and maybe Camden County, up on the northern part, you do a little bit, but it really starts at like Mercer County, I think, and up, and it starts at, what is that? Ocean County and up. Every deal has an attorney. So if I'm doing a deal in Brick, it might be $1,000, $1,200 for an attorney fee. If I'm doing a deal in Hoboken or Wall, it's like 2 grand. It's like a captive audience, and people love to pay these attorneys to do this stuff. And they're always on. It could be I'm doing a for sale by owner right now. It's up in Washington Township, wherever that is, somewhere up there.
Yeah.
For sale by owner, I got 2 attorneys, and they're family members. It's dad selling the son. Now you got to have attorneys.
Yeah,
I don't know why.
Washington Township's not too far from me. I have an office out there.
Well, maybe it's Washington. I thought it was Washington. It's Washington something. But no, it's up there. It's up there. Yeah. And even between dad and son, they still have to have attorneys. It's a New York state of mind. Well, New York is an attorney state. So the bank that I work for is, being that we're federal, I'm licensed in all 50 states and we lend in all 50 states. So whenever I'm doing a deal up in North Jersey, or I'm sorry, New York, rather, we always, not only do both sides, the buyer and seller have to have an attorney, but us as the bank, we have an attorney. So it's weird. Yeah. Yeah. It's kind of weird. It's the only place that New York is different like that. Connecticut's an attorney state. So yeah, so that attorney state of mind drifts into North Jersey. It's pretty aggravating. It costs the buyers extra money and time. I mean, you might have 3 weeks. You're still in attorney review.
Yeah.
Do back and forth, back and forth. It's not like down here. It's much smoother down here.
Yeah. From an agent standpoint, I mean, if they're gonna get an attorney, I mean, obviously we don't mind it. That's less work that we have
Yeah,
to do and less liability on our end. It's just
it
if
is.
you're gonna go with an attorney, make that known before we place an offer. That way each party knows about it, you know?
Well, you can even go one up on top of that. You know, if your buyer knows that he has an attorney and they're on retainer, sometimes they get them free through work. Sometimes they just find attorneys. Sometimes it's a family member. But hey, I mean, if you think about it, in a seller's market, if you have an attorney drafted contract of sale and it gets signed, there's no attorney review.
Yeah, that's true. I didn't think about
So
that.
deals will die in attorney review, man. You know, it's like highest and best situations, and you could be day 3 on attorney review and before midnight, and you lose the deal.
Yeah. I literally just had that happen like 2 or 3 weeks ago. I was in Boston. I knew it was gonna happen though, and I got the call and I was just like, "Dang. Well, okay. Next."
That's heartbreak.
Yeah, yeah. But,
My daughter bought a house a few, I guess it was a few years ago now. Maybe it was 4 years ago now. But, you know, I was all about helping my daughter. I think she was like 24 at the time. And, you know, we submitted an offer and, oh, you lost. And then we got it. You know, we're like, okay, we'll waive the home inspection. We'll offer gap insurance of $7,000 gap coverage, you know, in the event that the appraisal comes in low.
yeah,
Well, you know, we're offering all these things, and then we got it, and then we were under contract, and then, oh, we're in the attorney review. Oh, they're gonna go with this other offer. Well, wait a minute.
yeah,
It was like going back and forth for like 2 days, even after we were under contract, and then we were good.
yeah, yeah.
So attorney review is stressful.
It is, it is.
So that's the only good thing about an attorney drawn contract is if the other side signs it, no attorney review.
Yes, yeah, no, I'm gonna keep that noted for myself for the future. But, I mean, with attorney review, man, the way that I look at it is if that ever happens to you and your deal dies because of attorney review, maybe I feel like everything happens for a reason, you know what I mean? Maybe there was
It
something
wasn't meant to
with that
be.
property, you know?
Yeah,
You just got saved. That's the way I look at
might not have been meant to be.
it.
It's not always meant to be. Things happen for a reason, you know? Or here's something. I remember years ago, and I'm going back a ways, but I remember there was a popular thing where buyers would submit like kind of like family letters with pictures. Whereas, hi, you know, this is my family and my child and my dog. You know, we really love your house and, you know, we would love to raise our child in your home. And, you know, my husband's a police officer in the neighborhood and I'm a teacher. And, you know, they would give these, like, I want to say that they were sob letters, but they were letters of, you know, pick me to buy your house because we're these great people and your neighbors are going to love us. And in 5 years, you can come back and revisit and see all the great things we've done to improve upon what you already did.
Yes.
I don't know if people do that. I had heard years ago that in New Jersey, you're not allowed to do something like that any longer because that could create redlining or sway people from selling to somebody if they didn't like your family for whatever reason. Like, let's say you're Irish Protestant seller and you have a Catholic Irish buyer,
Yeah.
and you would not sell to them because they're Catholic and you're Irish. And
Yeah.
if they alluded to that in the letter. So, you know, for reasons like that, I heard you weren't allowed to do that any longer. Have you heard anything about that? Is that
No, no.
true?
So
Is
actually,
there buyer letters?
I was still getting told that I should be doing this. I actually just did it not too long ago. Did it about a month
Really?
ago with one of the deals that I was trying to put under contract, and unfortunately, they completely ignored the letter and they just didn't care, and we never really got a response. However, the way that I do it is probably a little bit different than most people do it. I don't just send it straight to the seller or leave it at the house or anything like that. I make sure it goes through the listing agent first, and that way I'm not going behind anyone's back or anything like that, you know?
Yeah. Yeah. I don't know. I guess you could not like the looks of somebody.
I guess, man.
You know, you could look like the perfect family, or maybe you don't look so good. This family looks a little sketch over here. See, that wasn't on my wall. I just, Yeah, it just popped into my head. I was thinking, because trends, right? So this was years ago that I remember that this happened. Because my wife used to be a real estate agent,
Okay.
and now we're going back a ways. My wife was my processor for 15 years, and I got her away from being a real estate agent to help me in the office. It was for selfish reasons.
Okay.
So she got out of selling real estate to be my processor for a long time.
Yeah.
And now she works at another bank, First National Bank of Epsecan. But yeah. So when she was selling real estate, I remember it was a thing. And then I think the office that she worked for wouldn't let people do it anymore because of possible nefarious reasons, I suppose.
Interesting.
But I was curious, thinking of trends. I've seen listings where I guess maybe where the market has changed more so from it being a seller's to a buyer's market where they offer things, keep the car that's in the garage, here's the keys,
Yes.
stuff like that
Yeah, my buddy, he actually, when he bought his house, they pretty much just sold it with everything in there.
with everything.
Yeah, they got new couches, new everything.
Yeah. Hey, you like this house? You give me full price, you can have the boat, and the canoes.
Yes, yeah, exactly. And the seller's market, man, it's very normal. A lot of what I'm seeing nowadays too, to go back to your question earlier, I'm seeing a lot of as is sales and a lot of people requesting for the
Right.
buyers to obtain the certificate of occupancy. And I mean,
Yeah.
it makes sense. It's just you have to make sure that you're protecting your buyers in that situation because it can be a little bit riskier. You know what I mean?
I had a lot of contracts that came with gap,
Yeah.
the offer price was so high, the seller's worried about, well, what if it doesn't appraise?
Yeah.
So then it's like, you throw in the gap, $10,000 gap, $5,000 gap, $20,000 gap, in the event that the property doesn't appraise. I don't know if that's still trending these days, though. Do you see a lot of
Yeah, yeah, especially when there's a bidding war, that's what
right,
agents are looking for because it protects you. You know what I mean?
right,
Yeah, because if let's say that you have an offer, like just to break it down for the viewers that don't understand what appraisal gaps are, let's say that you have an offer for $250,000 and the property only appraises for $230,000, but you have a $10,000 appraisal gap, you'll get the loan for the what I say, 230 it appraised for. You'll get the loan for 230, and then you'll put the $10,000 cash out of pocket, and then that will be the appraisal gap. That way, the seller is still getting a certain dollar amount, and it protects them. That is still very common, especially with the as is sales.
yeah. I haven't seen it quite as much on contracts I've gotten recently. I don't know why, but yeah, that was a big thing. The gap, the waiving the home inspections.
Yeah.
That's a popular one. I like the waiving the appraisal reports, but then you can't always waive the appraisal report. I don't know why that gets in the contracts because it's a lender thing. Unless if you were buying for cash, sure, you could do whatever you want. But if there's a mortgage, you might not be able to waive it. It's for lending purposes.
What I always do when I'm placing an offer and I want to put something similar to that, I say that the home inspection is for informational purposes as long as it doesn't reveal anything that will anything structural, electrical, or anything like that. And then we have the option to renegotiate if it does. And then lender required repairs, I always just keep that in there because, like you said, we have no control over that.
No,
Yeah.
no.
But to be honest, I've seen in the past where even if that's not in the contract, other listing agents, and this won't happen normally, other listing agents are understanding because they want to get the deal to the closing table as well. You know what I mean?
Yeah.
So sometimes they'll let that slide, but that's not all the time.
Getting everybody to the table is the most important thing. Yeah. That's how I get paid.
That's how I get paid too, man. I'm trying to get to more closing tables.
Get them all, man. Like Pokemon, get them all to the table, collect them all.
Yeah, but I think that we pretty much have a pretty good podcast going. Is there anything else you'd like to add?
Did I like to ask? It's a scary thing when it comes to buying a house. It's dependent upon the area of the country one person is in, like north versus south. And New Jersey very much is two different states. Buyers can be very frustrated because of so many people placing offers on properties. You just have to put on your patience panties. It's adulting time. You might see 10 houses before, one, you get an agreeable agreement and you're happy with the price that you're getting on the property. I don't know, always talk, with a reputable, real estate agent, like you are, Shawn. Don't be afraid to ask questions. There's no dumb question when it comes to the home buying process. Buyers are not in the business of doing this type of thing. So talk to your lender, talk to your realtor, ask a ton of questions. What I've started doing is trying to get everybody that I can to spend time with me doing stuff like this. If it's on a site like this or if it's a FaceTime, so that I can actually show my computer screen so that they see how the debt ratio works, what the capital is that they're going to need when it comes to down payment and closing costs, what it is that we look for and what they can improve upon, what pricing is like. Different types of transactions are going to have, very greatly varying interest rates. Traditionally, your government interest rates, like an FHA loan, would have a better interest rate than a conventional mortgage, oftentimes. And that's because of penalties related to conventional financing. They're called loan level pricing adjustments. And I like to show the customers how that works. And that's all part of the questioning process. So people should ask you a ton of questions, ask me a ton of questions. And hopefully, we can do some sort of a screen sharing option so that they can see what I see. I never hesitate to show my pricing sheets. I never hesitate to show the national averages or what the loan level pricing adjustments are or what treasury bonds, mortgage-backed security averages are doing. The more information that can be given, hopefully it's put to the right use and it creates comfort for the customers and moving forward, because it is a lot of trust. Families are in trust in me and you to do what's best for them. So, I guess that's it. Just make sure that you ask a lot of questions, like the answers that you're given, get shown things and how the process is. Because there's a lot of liars out there. I hear stories all the time of, this person was promised this interest rate or they were promised this program and then they got switched at the end or even denied for the loan. And that could be because of lying. It could be because of inexperience. So, a buyer needs to find comfort in their agent and in their loan officer. Very important.